Welcome to Tradier's The Trader's Edge. I am Jim Uriel. That's Bob Iacino. We have an extremely special show. We're tired of having these top-line guests who talk over us. Bobby and I just like to hear each other talk. So you're going to get just a lot of Bob and Jim today. Bobby, how are you?
Good. How you doing, buddy?
Good. And this last week, we were at the Money Show's Investor Symposium in Miami, the first ever one in Miami. There was an amazing amount of fabulous guests there. There was Jim Bianco, Tracy Schuchart. What was the guy's name who was the chief economist for Interactive Brokers? We heard him talk. He was great, whatever his name is.
Yeah.
Yeah.
I can't remember his name either. They were great guys.
John, he's a good guy, and he was really smart. I'll try to get his name up through the show. But Mitch Rochelle, it was excellent to see and hear everything. Particularly, Jim Bianco. Jim Bianco's kind of royalty in the financial world. What did you learn? What did you hear that was cool?
Jim has been on our shows multiple times. He's a friend of both of ours. And the interesting thing about Jim is how often he goes against the grain and how often in some spots of his view, he ends up being right. In other words, it's very weird. Like, it's just rare that he's wrong because he's so measured in what he says, but he's also so confident in his research. And I'll give you an example. He is the one who told us, oh God, it had to be a year and a half ago, that as inflation was starting to come down from those 8-9% readings we were getting, is that it was probably going to go down to about 3.5 or 4% and then turn back up.
He told us that
exactly. And his view was July of this year, that's when it was going to turn back up, and it was never going to get to 2%. Now, I don't think he meant, infinity, but it's literally playing out almost exactly like that, except it didn't get as low as he predicted, depending on which thing you're looking at. So that was kind of amazing. And he put out some new stuff about the problems with the debt, which I'll give you credit. He turned to you to ask about the numbers and about the figures. So I think it's something you may have sparked in his brain, and we may be hearing more about it from him in the near future.
That's cool. So tell me this. When you hear Jim Bianco and you compare him with me, over the last year, particularly because of the fiscal situation we're in, that everybody's screaming it's unsustainable. Jay Powell, Ken Griffin, the IMF called our situation unstable. The gold market is screaming at us that it's unstable. When you look, in my mind, I think we're in a speedboat. We're going very fast at the cliffs. Do I seem more negative about the path of it than him, or does he seem more negative than me? And then where do you fit in?
So I think he sees more negative than you.
Wow.
But I don't think he views it as negative. I think, and that's the beautiful thing about Jim. I do get emotionally tied to the positions I take.
Yep.
I end up arguing with some of the people on our show going, but don't you see this? Jim doesn't do that.
Yeah.
He's just kind of like, well, that's not what the data's showing, but okay. I mean, he's just so it almost doesn't come across as negative from him. But I think from a perspective of, he's very open to the idea of assets continuing, but he's not open to the situation continuing as it is. And he's been pointing out, as much as you have, that the Fed has been nothing but wrong, and he still thinks they're wrong.
Yeah, I was just on a show today talking about the Fed being wrong, you mentioned, because everybody goes about the fact that transitory was nonsense. The Fed was wrong. And how could they have known? Oh, except for the fact that 1,000 of us were screaming at him that there's no basis for you to believe that it's transitory. This is absolute nonsense. For you to keep buying bonds, particularly mortgage backs, is asinine. There's another thing they were wrong about, and I think this will be taught in monetary policy books forever. In 10 months' time, mortgage rates went from 3.25% to 7.5% in 10 months. There has never, in the history of mortgage rates in this country, there's been a bigger size move, but never a percentage move like that, 134% higher. And what happened was, it didn't do at all what they wanted it to do. All it did was choke up the supply. So when we talk about the Fed and their incompetence in this whole thing, everybody points to the transitory thing. And again, I know about 8 months ago, you said you want to stop bashing the Fed, but I had said I was just getting started. This is a new angle. I think they absolutely messed that up as well. Agreed?
Yeah, I would agree with that. And again, I think Jim agrees with you as well. The portion of it and while I ran for a little bit and then asked you a question, because I know you can multitask, this is the first time that I'm actually streaming this on X live. So I just texted you, or not texted you, I just DM'd you in X the link to that. See if you can send that out while we're talking, and we'll see if we can get the numbers up and make this worth it.
Hells yeah.
Good numbers already, actually. Pretty high double digits, which I'm happy about. But to your question, from my perspective, the bashing the Fed, it's just one of those things that got boring. It's like if you're actually sitting there and saying, okay, the Fed is the problem, the Fed is the problem, the Fed is the problem. It's like walking out with an umbrella every day that it's raining and going, you know, I have to carry this umbrella because of the rain. It just becomes a little theater of the obvious for me. So that's really what I got bored with. But I will say that anyone who has not paid attention to what you've been saying, and then I have a question for you, if you don't mind. You've been saying for a long time that the Fed is just terrible at their job. And what do we have right now? We have a Fed saying it's going to be appropriate to cut rates in 2024. When they first pivoted, the market priced in 7 rate cuts by the end of 2024. Fair play, that actually included a rate cut in 2023, right at the end. They priced in 7. We're down to 1. And that 1, according to the CME Fed Watch tool, is a 45% chance of a 25 basis point cut in December. Now, there obviously looks like they're wrong again, right? So my question for you, you have been setting yourself up with short options positions lately, equity-wise. Mm-hmm. I know you covered your Nancy Pelosi NVIDIA. You might want to tell that story again, but you covered your Nancy Pelosi NVIDIA longs. NVIDIA today, by the way, down 3.5%. Actually, semiconductors getting killed today.
Yeah.
ASML, I think, was the big, actually, they weren't even the biggest mover. I think the biggest mover was ARM Holdings. ARM Holdings, the semiconductor company, down over 11%. And don't quote me on these percentages. ASML was down over 7%.
Jesus.
AMD was down over 5%, and NVIDIA down 3.5%. Okay. Right. Semiconductors getting killed. You sold your NVIDIA, and you've been setting yourself up for negative positions in the NASDAQ, or I should say, we'll call them hedges or whatever you want to call them. Did you take anything out of the Miami Summit? And by the way, we're going to be playing that Miami Summit on this channel next week.
And you guys
our entire breakout session. You guys are going to love that. Did you take anything from that summit that made you want to change that position?
No. Everyone I talked to seemed to confirm my belief that without, many of them didn't say it explicitly, but confirm my belief that a 10 to 12% pullback in equities is reasonable right now. I'm talking about the S&P now, not the NASDAQ. And again, I was very much positioned for that. Today, I essentially took off half my hedges. We were down like 5.5% at the time. Yeah. Not because I think we're done. I just think it's prudent to have had those hedges on so well. And by the way, the hedges have grown too. So it's almost equal to what it was on the top. Do you know what I mean by that? Like when you have puts on or put packages, is they explode in value. So I took half of them off, and it still left me with a similar level of put protection that I had on when I bought them at the top, several weeks ago. I didn't buy all of them at the top, by the way. So I still fully believe that we need about a 10 to 12% correction in the S&P. I think 4,700 is relatively reasonable, but I'm going to start at every down move. I'm going to start selling those puts, the 4,700 puts, because that's where I want to buy it again. Does that seem reasonable to answer your question?
It does. And I'm actually going to share a screen here. Hey, Logan in the background, I'm going to put a screen in here. If you could put it up as soon as you see it. Is Logan back there, or is the Terminator back there? Who's back there today? Oh, it's one of them. So this is a weekly NASDAQ chart. Okay. So something I'm going to put up here while we have this on is I'm going to measure from where we are. Let's go from the high close, which is right here. Yep. All right. And I'm just going to go down about 12%. That's the wrong tool. Hang on.
That was cool, though.
So technologically advanced. That was
we are so people of our generation are, that's a hallmark of us almost 60-year-olds.
So there's here's 12%. Okay. And there's a reason why I wanted to put this up here. I have this is a weekly chart. I have 2 vanilla support lines, and this is the NASDAQ future. We can do this with the QQQ if you guys want as well. Everybody knows about the breakout that we had above these highs, these July 2023 highs, and that happened November 13th. We had a breakout, we had a retest on December 4th, and we went off to the races. Then we did this little rotation here, right? This was the week of December 26th. We had a little bit of a breakout here, a weak retest, but still, if you look at this low, the week of January 29th, and you compare it to the high of December 26th, it's retesty, right? shouldn't say testy. That's all right. If we get a 12% drop, all it does is take us down below this first support level, which I just mentioned by calling it testy, that it wasn't even that great. That's 12%.
Yeah.
We're not through the 50-week moving average. We're not even close to the 200. So I guess what I'm saying here is for me to turn bearish equities, here's another vanilla level you could look at here. If I get the horizontal tool up here, you could look at this vanilla support and resistance level right there. I'll bet you that's going to be around 10%. Let's just measure it. There you go, 10.62%. So 10 to 12% to me is perfect. It's reasonable, and it doesn't take you out of a bull move. We've made a new all-time high. That's a bull market.
Yeah. It makes me like the bull move even more. You know what I mean? If we take off, we blow some of the froth off, we get to a level where we build a little bit and then start higher again, I'm fine with that move. And again, I was positioned for it. You know, it's so funny when you like as you know, for the last 6 months, and you've known me for many, many years, but for the last 6 months, everything's kind of going well. So then you fall into the thing where you start to think you're a genius and never going to have another losing trade again. You know that actually happens, right?
Yeah.
And then all of a sudden, the risk will come around and slap you in the nards pretty soon, which could easily happen. And we should work nards into every one of our shows if we're going to actually change the name of it to.
Yeah, we got a decent live crowd right now, so we should all let everybody know that you're trying to bring back nards.
I'm trying to bring back the word nards. I think it was great in the 70s and 80s. It's nostalgic and it's funny. We should remember that. And people, please leave in the comments what you think of the nards talk. But anyway, Bobby.
So we have a comment from Chris who actually kind of summarized well why I got bored with bashing the Fed. Chris Allen says, bashing the Fed is rather boring. It's the morons in Washington who can't stop spending that are to blame. How much are rate hikes discounted by the ever increased spending? Jimmy, this is your thing.
This is, I think, pretty much all of them. I think that they raise rates to break up demand, right? And at the same exact time, the federal government has been just jamming money into the system to increase demand. This is the single dumbest juxtaposition against fiscal versus monetary that I've ever seen in my lifetime. We're increasing the federal debt $1 trillion every 100 days. That is to call it irresponsible is to give it about a 3-rank upgrade. I think that's a great question, Chris. And if you want me to start bashing the federal government, we are simpatico, my friend.
And so speaking of that bashing, that it was the biggest theme that we heard from the people that attended this investor symposium. Literally over and over again, the irresponsibility of government fiscal management was one of the biggest fears and one of the biggest questions we got when we did our breakout we did a keynote speech, Jimmy and I, and then we did a breakout Q&A with the crowd that came to our breakout session. And that particular crowd, constant questions about when is the government going to stop? Because would you say that, we saw some pretty big speakers in Miami, and I think the main takeaway from this was that the federal government's been fighting the Fed. What do you think?
I think that's the main takeaway. I think that there's different facets to that as well. Not only they're fighting the Fed and fueling inflation, then they parade out all these economists who have, political ties, which to me means you're no longer an economist. The second you have one political tie, then the arrow isn't starting at 0. But anyway, they come out and they say, well, look at this data. Aren't things going well? And they never mention the 34.6 trillion, probably 34.7 trillion by the time we finish this show. I think it is crazy. It's irresponsible. It's toxic. But more importantly, it's really, really dangerous. And it puts us in a position that we have to prepare ourselves for the possibility. Now, even if you believe, like I do, like 5 years ago, if you would have caught me and said to me, what's the chances that we're going to have a currency crisis or a debt crisis in the next 10 years? I would have put that possibility at a 0.001% chance. I think that chance has gone up to 5%, maybe 8% in the next 10 years. We're going to have a currency debt crisis. I actually say in the next 5 years. That is wholly irresponsible. So that brings me to the portfolio that I've been adding to, which is gold, silver, platinum, Bitcoin. Real estate. I bought real estate ETFs, but I actually got out of one of the properties that I owned, but only there was different circumstances that surrounded that as well. but I'm still heavily invested in real estate as well. And I think it's, goes back to the Dennis Gartman thing. When situation like this and you worry about the currency, and this is how I think it's going to play out. And give me the sign if you think I'm ranting too long about it.
No, go.
Shut up. Okay, this is how I think we're going to play out. I've talked on shows over the last several months about the reverse repo market, how it's either draining down to zero, but it seems to have kind of flatlined at like 450 billion. Jim Bianco mentioned that in Miami too. I don't think it matters, because if the Treasury is looking at that, and that's where they were going to raise money, was 3-month bills into the reverse repo market. If they're looking at that saying, well, crap, we don't want to run that down to zero anymore, so let's look somewhere else to sell our Treasuries. And it doesn't matter if it went to zero or not then, because they have to go to sell. And we had another bad auction. Was that this week where we had a 10-year auction that was sloppy? Yep. Yeah, this week you had a 10-year auction that was sloppy, and they're going to get sloppier and sloppier because of the amount of debt issuance that the Treasury has to put out there. I think then the Fed will step back in and start buying bonds at some point in time. I don't think it's till the 10-year gets to around 5.5%, maybe even 6%, that they're going to be like, okay, let's buy bonds. And what I'll put up for evidence of that is just last week, they quietly announced that they were cutting almost in half their quantitative tightening program. And then I'll go back to tape to last March, where the second there was stress in SVB and in the banking system due to the mark-to-markets of the bonds they were holding, the Fed opened up that window again and started buying with your money, people. With your money, they started buying bonds at par that weren't worth par. Very generous of you guys to overpay for that shit. And they boosted up their balance sheet. So I think that could happen. And at that point in time, I think the dollar suffers, perhaps not against the yen and the euro, because I don't give a shit against the yen and the euro, but against stuff. And that's why I'm long the stuff. Does that make sense, Bob Iatino?
Was it Jose Torres?
Jose Torres, that's the guy. He was really good. Jose, sorry we forgot your name, but I really liked your speech.
Yeah, it was really good. No, I think that makes a lot of sense. And one of the things that I took away, and actually is something that Jim again mentioned, I think Jose mentioned this as well. The Fed, we saw 2 days ago. No, it was yesterday. Jerome Powell spoke, right? And one of the quotes that was getting flashed all over the place was, rates may be higher for longer, right? So this is Jerome Powell who just said
that the whole time.
Yeah, in the prior speech, he said that rate cuts will be appropriate by summer. I mean, it's hot here. I'm in
getting
Florida.
warm here.
Yeah, so
see the lilacs.
I don't know. I mean, I know summer's not as long in Florida. I don't necessarily think it's long everywhere else, but when's that going to be appropriate? So what I think, one of the things I took from Miami that was a consensus view, and not a consensus like you need to fade it, okay, but like a consensus view that it just made sense, was that they are not hiking rates. If anything, okay, if inflation keeps going, which I believe it will, they're going to leave rates the same here. Jerome Powell said that he believes fiscal policy is tight enough to leave rates at their current level. And I'm not sure he's wrong on that. And this is something that maybe they're getting accidentally right, which is why I put that NASDAQ chart up. The big fear for me is something you just spoke about. And that is essentially what you spoke about leads to a banking crisis, a regional banking crisis. We're not going to see Jamie Dimon coming on and needing to borrow money from the Fed.
Not at all.
But we might see your Truists and your Fifth Thirds and companies like that start to really suffer if they don't get rates down at some point, or if rates move at all higher. And there's a portion of what we call the yield curve that they don't control that can still affect that. I still want to put out just the sort of general call to any of you regional banks who have not hedged your leave to maturity portfolios to call Jimmy, open an account, and he'll get you hedged right up. He doesn't
10
worry about
minutes.
it, doesn't bother
10
him.
minutes.
Real quick, everybody who's watching this live on X, can you retweet this? Let's get these numbers up, because I, along with, who's in the back right now? Shinola's in the background?
I think so, yeah.
Yeah, Shinola has been trying to get us to be able to put this on live, and Logan disagreed with him, but Terminator was on board with us.
Yeah.
So all these guys, we wanted to put this on X Live, so if you can, just retweet it so we can get the numbers up a little bit more. Anyway, Tracy Schuchart was on stage with us, okay? And she had what I thought was one of the best moments of our breakout session, and I'm going to use my stapler here as the microphone. I just broke the stapler. That's fine. She basically, Jimmy said to her, do you think that, I don't remember the question, You remember the
was
question?
about the the government showing any fiscal restraint into the signs. I believe. I go, do you think they'll slow their spending down if things start to get dicey? That was the
Yeah.
question, right?
And she basically grabbed the microphone and she went, no, just put the microphone down. And then she went into sort of the overall structural mess that we have with fossil fuels here, okay, with fossil fuels in general. So you look at crude oil over the last few days, and crude oil has now been pricing out geopolitics, right? Crude oil has been pricing out the fear of geopolitical supply disruption. I think that's naive. So you had a couple of speeches the other day from, well, I shouldn't say they were speeches. There were reports of Iranian officials telling Russian diplomats that they did not want an acceleration of the conflict. Obviously, they don't.
Right.
They shot a bunch of drones at Israel and like nothing landed.
Yeah.
Now, I'm not a geopolitical strategist, so don't get at me about me being wrong. I don't know. All I'm seeing is what's reflected in crude oil. And what's reflected in crude oil right now is that it didn't work. And therefore, I think the market is incorrectly assuming that Israel is not going to retaliate. And I believe we saw some comments, might have been late yesterday, where it said Israel still reserves the right to retaliate. And then the commentary was they probably will retaliate against Iran for those failed attacks. So the biggest problem I have is if you believe the economy is accelerating, I do. If you believe inflation is accelerating, I do. And if you worry that geopolitics is always a negative in that realm, I do. Is this a buy the dip scenario at some point in crude oil? Obviously not today.
So can we get a chart up in crude oil? Because I came up with a trading thesis.
You want
today.
a daily or weekly?
Boris, will you put this one up?
This is Boris this time. I got it. All right, let's get this shared screen up here. I am really good at this. Give me a second. I got a weekly here. Tell me if you want something different.
It's fine as long as it goes out a couple of years, because I want to talk about that bull pennant that we broke down out of. And when we go back into a break to the upside, I will actually believe that the race is on. So
I'm going to get rid of my little long-term channel here. And I'm going to pull up the channel tool here, parallel channel. And I believe it's this one you're talking about.
Yeah, that's the pennant I'm talking about. And we broke significantly below it today, right? There's no question.
Yeah, we did. I drew it very best fit here. This isn't perfect.
Yeah. And it's, by the way, it's fine. If I don't get what I want, I just won't make the trade. Yeah. But as soon as it goes above and starts to break out of that pennant to the upside after this weakness, I think is when the green light happens. And that's when I will probably load up. And then when it goes above that one wick, I noticed that today too, a settlement above that wick, perhaps even buy it again. The one where you drew the red line right at that top there. So buy it again up there. So I think the fundamental story still remains bullish crude. This move back shows great relief right now of what's happening in the Middle East. And perhaps that's the right move. Perhaps it goes down from here and I'm wrong, because I have some small trades down, but they're more investments. But my trade is going to be when it moves above that to the upside. What are your thoughts on that?
Yeah, so I had a pretty widely publicized long trade that I took around here. It was in late March. We talked about it on multiple shows.
Sure.
And I got out of some of it here. By the way, this is a daily. I kept telling you it's a weekly. It's a daily.
I thought it was.
I got out of it, some of it in early April. This red line represented my target for the whole trade. Okay, and what I decided on that, by the way, for those of you that maybe don't have as many years doing this stuff as Jim and I do, for me, a target isn't necessarily a place where you cover a trade. A target is a place where an action is required. And I mean required. Okay, you either need to tighten up your stop, scale out of the position a little bit, sell some calls. If you're somebody that adds to winners, that's where you're going to add. It's just a place where an action is required. So I go back to this area here. I did not sell my position. I had lightened up in it here. And I said to myself, if we go into the rotation zone, and for me, the rotation zone is, without having the time to explain what this actually is, this is a 21 period exponential moving average, and this is an 8 period. And when this is widening and angling up, as it was in here, it becomes a rotation zone for me. I don't use it as a long or a short signal. I use it as a place to get in a trade, which would explain why I got in here, right? Because it went into the rotation zone started expanding, I get long. So my idea was I was going to tighten my stop up and reinitiate the longs I had lightened up here. If we went into the rotation zone and rotated back up, we did not. I got stopped out on my last batch at a profit. Okay, so I took profits and I got stopped out at a profit. Wasn't as big a winner as I thought it would be, but it leaves me with money in the bank. I didn't lose money on the trade, getting ready for what I think is a 100% buy the dip opportunity here in crude oil. And I'll tell you why. Seasonally, we're going into the biggest demand season domestically for crude oil, which if you look at a seasonality chart, it generally starts about May, believe it or not. Summer driving season doesn't officially start until whatever holiday is at the beginning of the summer that I'd never remember. One of them's Memorial Day, one of them's Labor Day. We might
can't remember which one's which. Memorial Day's the spring. Yeah, right.
All right. So that's sort of the official start of the season. But speculators start using seasonality starting in about late April, early May. So there's going to be a natural seasonal tailwind behind crude oil. Now, if you've ever heard me talk about seasonality in any of my CME videos or anything else I do, seasonality is not a trading strategy. Okay. I know guys that trade it, but they put on like 3 trades a year. Okay. They play, I go long from here to here, no matter what happens. I go short from here to here, no matter what happens. It's not really a trading strategy. So, but we are going to have a seasonal tailwind, which means all else equal, there'll be a slight tailwind pushing crude oil higher. I should say pushing demand higher. Number two.
Did you read the article about that might sell more of the SPR? But you finished your thought before we address that.
I did read that, which is funny.
I'm laughing my ass off. Yes.
Complete comedy. But so the second part of it for me is that that summer driving season. I was watching a guy from Goldman Sachs, and God, these big bank analysts, especially in the commodity space, they really kill me because it is so much easier to do that big bank analysis thing in stocks because you could say, I think Tesla is going to 500. And when it drops to, 165 or whatever, you go, yeah, I still think it's going to 500. It's no problem.
I didn't say when, right?
Yeah. Commodities, man, guys, it's just like commodities can go to zero, as we saw a couple of years back with crude oil. Tesla ain't going to zero. So the guy can just say, yeah, I think you should add here. It's still going to 500. So this Goldman guy said, we see the easiest move being down. Yeah, I mean, it's easy to say with the chart I just showed you, right? Sure. As we turn lower. And he says, I think the easier trades are down right now. A couple of weeks ago, Goldman Sachs had crude oil going to 100. Right now, the easier trade is down. So they just flop all over the place. But the guy said something that interested me from a perspective of taking a long. He said he thinks OPEC will actually increase production because prices are higher. I do not think they will do that yet because I think they know now. And I disagreed with Jim Bianco. Maybe it wasn't Jim. I don't remember. Somebody said to me that we're the marginal producer and might have been a guest on our show. I remember it was Samantha.
Oh, yeah.
He said, we're the marginal producer of crude oil. I said, no, we are not. Because what we do as sort of a mercantilist capitalist society, we drill a well, pump all the oil out of it, period. Doesn't matter what the price is. Just get it out and sell it. Get it out and sell it. OPEC doesn't do that. They're a cartel. They restrict. They try and control price. American drillers, we just drill it. And because we have anti-fossil fuel policy through and through in the government now, they have not been spending CapEx on exploration. So we're going to get a situation where OPEC could potentially increase, but US, and Tracy said this in Miami, Tracy Schuchart said, she thinks we're kind of at peak production, give or take 100,000 barrels or so. Maybe we get another 100,000 next month, maybe another 100,000 after that, but we're virtually at peak production for the rigs we have, and it's going to start trickling off. So even if OPEC does kind of overproduce or kind of not match their production cut quotas, it's unlikely that they're going to announce it. And it's even less likely that they're going to somehow try and save the US economy and the US oil industry by pushing prices down with overproduction. I doubt it.
I love that. So it brought up something, Charlie Munger always you said is you show me the money and I'll show you the motivation. You show me whatever it is.
Show me the money. I'll show you the motivation.
Exactly. So I was thinking about OPEC right now because the motivation exists to talk oil prices up while you secretly increase production, right? That's where the magic happens. So what they do and what they say they do might not hook up, right?
Right.
Okay, good. So now let's get to the selling of the SPR. Bobby and I cannot say this without laughing because we are how many months before an election? 5-6 months before an election.
Yeah.
They're absolutely they've already sold half of the SPR and then they bought back like a 20th of that. Correct? I might be getting some of the numbers wrong, but it's reasonably close. They just floated out another headline that they're considering doing that again. I think their hopes are that when they sell the SPR, what they're hoping is other people start selling crude alongside, because on its own, it's a significant, substantial amount of crude. And Bobby, you know more about this than I, but it's not enough without tag-alongs coming in to really move the price of crude, correct?
Yeah, the actual the Department of Energy, when they first started the SPR releases, however long ago it was, a year ago or so, the Department of Energy themselves actually said it's had about a 17-cent effect on gas prices. Total. That was from the Department of Energy.
Right.
And it was temporary.
Yeah.
So again, their own Department of Energy. Yeah, I don't know.
To my point, the hope is that once they are the biggest seller of crude in the marketplace at that moment, that others, like trade along with the Fed, trade along with them, and that others will be hammering crude at the same time. Now, I don't know if they got that or they didn't get that. I don't think they're the world's greatest traders. That's a joke. I think they're could conceivably be the world's worst traders. Like when they told us, yeah, we're going to buy a crap ton of crude at 70. What kind of sober trader tells people that? It's just never. It doesn't make a lick of sense. But anyway, I think that if they announce they're going to sell more SPR, and if they sell more SPR, I think that will have a bullish effect on crude. And I haven't quite figured out in my head why. Can you tell me why I might think that?
Yeah, because so it's funny. You remember back in the day when we actually had sort of surprises from the Federal Reserve, back in like the 90s when they would do things and they wouldn't kind of announce it.
Yep.
This is kind of similar to that. So we would have people who were expecting the Fed was going to do stuff, traders, and then the Fed didn't do anything. Let's just say we were expected they were going to cut rates. Okay. And they didn't cut rates at the meeting. So then guys would start just buying yields like crazy, just for looking for yields to go lower because they said they're now behind the curve. Remember that? Yep. They're behind the curve now, so we got to go in the direction that we wanted to go in the first place.
Fascinating.
The SPR, the government is going to be really behind the curve. Think about this. People were saying, look, this is people who were sort of pro-administration. This is not a political comment. I'm going to throw that out there first.
Never is.
People who were pro the administration were coming on when I would say, and Jimmy would say, that they shouldn't be selling the SPR for this purpose. They would post up the definition of, or send me the original documents that created the SPR that said, this is to be used in price emergency to relieve prices, right? Or in case of emergency to relieve high prices. But we all know the intent was to make us survive an embargo again the next time, right? The next time that it happened. It wasn't to accrue political favor from the electorate because prices had gotten too high because of the market. It wasn't to alleviate the stress of bad fossil fuel policy, right, before the next election, which is what this next release of the SPR should be viewed as. Okay, It should, I don't know if it will, but it should be viewed as pacifying the electorate so that it takes their eye off of bad energy policy, which is going to hurt. Again, bad energy policy hurts the lower middle class and the poor. That's who it hurts. Amen. The people who are trying to get to work, and when they fill up their gas tank and it's $70 instead of $40, can't buy milk, right? That's who it hurts. Doesn't hurt us.
Oh, yeah. It's absurd and it's ridiculous. Yeah. It should never be forgiven what they do that. They are sacrificing power today.
Yeah. Now imagine the geopolitical problems between, let's just say, Israel and Iran, gets taken out to the woodshed where the U.S. sort of gets involved. Yellen was already talking about more sanction on Iran, which, by the way, they had violated a nuclear policy, a nuclear treaty, right? An anti-proliferation treaty. We still have sanctions left. Like, she's talking about more sanctions. Shouldn't we have all the sanctions on them from that? But anyway.
Not only do we not have the sanctions on them, we continue to give them money.
Yeah. So she's talking about more sanctions. If this accelerates, Iran is like 3 million barrels a day now, man. It's not a joke.
Yeah.
I sound like, not a joke. It's 3 million barrels a day. It matters. It's an amount of crude oil that matters. So you get that. And then let's say you get sympathy from some of the other oil producing nations. Not going to be Saudi Arabia, but it could be the Emirates, could be any of those, could be Venezuela to a certain degree, where you get sympathetic cutting of production. And now you have what, a month of SPR left? I mean, that's brutal. People don't understand there's different viscosities in crude oil. The crude oil that's drilled here in the US doesn't make us energy independent. It gives us a very desirable grade of crude oil that we can trade for other types of crude oil we need.
Okay.
Right? 1-to-1.
Right.
Well, maybe not 1-to-1. I don't know that much about it, but you could drill 100 million barrels here of light sweet. And we still have to get other kinds of oil from other places like Canada, Mexico, and some of it from the Middle East. But we have like a very desirable, easily refined brand of crude oil, which is light sweet, that you can then trade for that crude oil, and you become sort of synthetically energy independent.
Right. Because they need you then too.
Right.
Right.
Exactly.
That actually makes a lot of sense. Can we, on the rundown, we talked about gold a little bit. I'd like to talk about gold and Bitcoin before we go. Can we pop up a gold chart and talk about this?
Yeah, I can do that.
We haven't talked about it on this show yet, right? Today?
No, I don't think we've talked about gold. We talked about it in the rundown.
Yeah. Okay.
So if you haven't, you know what? For the purposes of this, I'm going to put GLD up.
Sure. It's fine with me.
Which
Remember, I'm a futures trader. I make no recommendations in any ETFs or stocks. My licenses don't allow for that. Thank you, my lawyers, Mark and Stacy.
There you go. Here's a GLD chart, and this is just a vanilla chart. There's nothing on here but my rotation zones.
Yeah.
By the way, I learned from.
I am making a mistake that it's a futures chart. Okay.
Yeah, and I have to tell everyone these rotation zones are the use of them and having them with the 8 and the 21's creation of Mike Arnold from Path Trading Partners. I call them mine, but they ain't. Just for the record.
No, and he's excellent. He's one of the better technicians we know. Okay, so what's not to love still? I don't see, the fundamental case for gold is that we're spending money like drunken sailors. The stock market right now is taking on water. And by the way, like we said before, the stock market needed to take on water. It had ground up too high. And a lot of times these moves are market position based. So stocks rallied, gold rallied even when stocks were rallying, even when the dollars were rallying, even when the yields were going higher. Now stocks and Bitcoin are being taken out of the equation. Gold is, for a moment, 2 of the last 4 days was like, oh shit, risk is being sold. We should be sold. And then it was like, well, no, we shouldn't. If you arrange this all in your Sudoku, it's like, no, buy gold. I think if it breaks out of this little consolidation pattern on the upside, the next couple of days, I think it's ripe for a buy again. Are you at all negative on gold or no?
I'm not. I heard something really telling today, or something I thought was really interesting. By the way, Dana Samuelson, he was from Amerigold. He's somebody we met in Miami as well, American Gold Exchange.
Oh, yeah.
The company, Dana. And we're going to have him on one of the shows, probably our regular podcasts, because there's more of a stock audience here. But the GLD, or the gold contract, to me, we've come into a new range in gold. So if you remember in the past, we had, and actually I'll spread this chart out a little bit more so we can talk more intelligently about it, and I'll put up a weekly so it'll make more sense. Gold does this thing where it creates a range and then it travels within that range. So for the longest time, you had gold with, let's put this line right here. I need to move a little higher than that. Well, we can go here. Now, this was a spike. When was this? This is 17. Well, fine. We had about a 1900 ceiling in gold for a long, long time, right? Call this, 2020 to about 2024. Mm-hmm. All right. Now I can tighten this up even more, and I can say that we had a gold level here from these further years where gold really wasn't getting above. This is GLD, so 130. So just for the sake of talking about gold price, we'll call it 1330, right?
Yeah.
so that people can relate it to the gold chart, right? We had a long period of time here, and this was a stretch of about 2013 to about 2019. The thing I heard today was that 2000 or 1900 is probably the new low in gold.
Makes
So sort
sense.
of this new, sort of like, let's call it a 4 or 5 year range. The low end of that is going to be kind of where we are now, 1900. So you could draw this same line on GLD that I've been drawing these lines. Let's draw one here. Okay. And you're talking about it being around 192. So let's call it 1920 for lack of having a pure gold chart up here. This, he said, is going to be the new low. So if I duplicate this line, and let's just put it up to the highs that we currently have, okay, then in theory, you would have a situation, let's put it up here at about 2200. You would have a situation where over the next 10 years or so, and let me shorten that, 5 years, you could trade gold between about 1900 and 2200 in and out of here. And if it breaks, that means something broke.
Right.
Right. And then we're looking for a breakout above here. Now, I believe it's going to get above here. I'm still sticking to 2024. I told a guy this. I actually walked into a place called Executive Bullion in Fort Myers, Florida, and sold a coin about a year and a half ago, and sold a 1 ounce gold coin. And the guy next to me was selling a stack of them. And I'm like, you sure you want to do that? He's like, well, you just did. I go, no, I sold one coin. I want to pay cash for something that's kind of under the table. Don't worry about it. And yeah, don't anybody ask me any questions about that. But, I said, I'm just selling one. And I said, there's more. Where that came from? And he goes, no, I'm selling them all. This thing never goes up. And I said, really? I think 2,800 by 2024. He goes, no way. I said, I will meet you back here December 27th of 2024, and we'll see who was closer to right. He goes, if you're right, I'm giving you one of these. I'm like, well, then don't sell one of them. How about that?
How about that? Right.
Yeah. But so that's my feeling on it. I don't see any reason to take gold out of holdings. So Jimmy, I think you do this too, right? I have physical, but I trade these things.
Yes.
These charts, right?
Yes.
So my long gold trade I'm out of.
Okay.
But my physical gold, I bought it in November of 2022, and I'm still in it.
No, I bought most of my physical gold when storm clouds were starting to gather in was it 06 or 07?
Mm-hmm.
And I thought that what was going to happen again. I don't know if you remember Alex Manzera, who's one of my partners for a long time. Wonderful guy and a smart guy. And he laid out in great detail what was going to happen with the banking system and with real estate. He just kept saying it every week. But anyway, I bought a bunch of gold. It was like trading at $600 an ounce, maybe 700. I called 10 of my closest friends and said, listen, shit is going to hit the fan. These are some family members too. Buy gold, buy physical gold. Do you know how many of those 10 people went out and bought physical gold? I've never given them a tip on anything before. Do you know how many bought? I'll give you a hint.
Yeah.
Right. It rhymes with Nero. But anyway, and now they're all like, gosh, I wish you would have bought it. I'm like, I'm never telling you anything again, by the way. But anyway, so I keep physical gold. I do have gold holdings in paper. Again, I don't talk about the ETFs, but I have that as well as part. And I'll actually just some of my new money I've arranged in the Jared Dillian awesome portfolio, which I find highly intriguing. But that's money that I do not trade. And if you guys want to know what the Jared Dillian awesome portfolio is, get his book. No worries. But if
I could, I want to put one more chart up.
Sure. While you're pulling it up, that gold chart, by the way, when I look at that, 80% of what that chart is telling me, that's just the inverse dollar chart. The other 20% is global central banks picking it up. They've been the last 2 years, they've bought more than they've bought in the last 75 years. But it's mostly just an inverse dollar chart to me.
All right. So this is Diamondback Energy. And so I usually trade crude oil if I'm going to trade something. But what I've got up here is a Fibonacci retracement extension, or you can call it a trend-based extension. But I've changed the level to Gann. Okay. So you can see all of these are 12.5 apart, right? 0.125. What's that? 12.5%?
12.5%. Yeah.
12.5% apart. Okay. And if you look at kind of the reactions, I love the reactions to the levels on this. And what we saw here was a spike up to this 137.5 extension and then a failure below that. I've got my rotation zone coming in at basically what would be the 100% retracement extension of this. If you don't want to buy gold, if you don't want to buy, go into USO, or you don't want to open a futures account, FANG is my favorite energy stock if you decide to buy it. Okay. And what I would personally do in this particular trade, and this is not a trade recommendation. This is what I'm going to do with this. Okay. I actually don't want any of you to do this trade. Actually, I just decided I'm not going to say what I would do because I don't want to fall into problems. This is Tradier. There is a compliance department. And we just had a conversation about my cussing. So I didn't cuss as much. But there is support here on this particular chart below this 75% here. Take it down to about 170, 192 or so. There's good support. So if there's a longer pullback in FANG, again, this is a weekly chart. If I go to a daily, I could kind of dial in what's going on. And what's happening here now is I'm pulling into the rotation zone, and the rotation zone is turning lower. All right. Now, if this were to turn up and widen, or if it were to cross lower and then cross back up again, I'm looking hard for longs in this. And this is going to be along with likely the price of crude oil, because Diamondback Energy has one of the lower break evens in the shale patch. Okay. Their break even is somewhere around $45 a barrel. Yeah. So they are a shale oil company, which makes, they do other things, but that's what they are. And they have a lower break even than a lot of these companies. So if you're looking to possibly buy a rotation back up in crude oil, but you don't want to get into crude oil, I'd recommend you look at this stock and see if it fits in with sort of your strategies and your risk metrics. Is that balanced?
Yeah, that's very, very balanced. We make no recommendations. We tell you what we're looking at, what we may do. We don't know the depth of your pockets or your risk tolerance. So you're on your own. I just had an epiphany, and you are going to make fun of me for this. I have always wondered why the hell Diamondback's stock symbol was FANG.
Oh, no. Come on.
You knew it already? Like you got it right away?
Of course I did. Okay. Of course, I live in the area where they have Eastern Diamondback rattlesnakes. So
it just now dawned on me, because I wasn't, why in the world is it called FANG? Now I know. FANG, a snake.
And they're in Texas. They have Western Diamondback.
I get it now. They actually have Diamondbacks.
Oh, my God.
Okay. Yeah, that was silly of me. I apologize. Let's look at Bitcoin, because there is a technical thing that I'm looking at.
Let me keep this chart up. I'll just change it to Bitcoin.
Okay, good.
What do you want? You want like Coinbase's Bitcoin? Let's do that.
Yeah. Right. So here, I just want that 60 level, or whatever level it kind of broke through today. That to me, I think is a big deal.
Right there.
Yeah. Okay. So we traded below that today, which is significant. Seems very, very important, right? Now, here's what I believe is going to play out. I believe it maybe plumbs those lows a little bit the next couple of days and see who they can get to bite. And then it reverses. I still have my longs in Bitcoin, but I'm not trading this yet. But if it can show me resilience and reject these lows, start trading to the 62 to 65 level again, I think it's going to set up for a buy. Give me your thoughts on the chart.
All right. So I like that you preface that, because I'm going to do something. You have to tell me if you can see my drawing. Okay. Can you see if I do this? No, it just moved, right?
It moves. Yeah.
Ah, crap. I want to draw on this thing right now because I'm desperate to kind of, is this a paint? Well, now it's just going to get, never mind. It's just going to get weird. Yeah. I don't want to add text. All right. We talked about the rotation zone a little bit. Okay. And I need to zoom into current price action. So here's a rotation zone going up and widening, right? Here was a move into that rotation zone. And then you could see there's a nice little buy signal here that takes you up to these highs. Here's a move sort of mimicking what happened here, right? Comes down, touches it, and then breaks down. Now, we didn't get any sort of cross down. Doesn't matter. I don't trade the rotation zone in this kind of price action at all. All right. I don't even look at it. As a matter of fact, it's not a rotation zone when it's shaped like this.
Right.
Right. But what it's doing now is it crossed lower, meaning the faster one crossed over the slower one, right?
Yeah.
And you can see it's starting to widen, right? And it's starting to head down.
And that's not good.
Well, it doesn't mean anything right now.
Okay.
What it does mean is if it continues in this type of movement, okay, and we see price action, and this is why I wanted to draw on the chart, and we see price action go up, whoa,
Yeah.
Never mind. You still see the chart, right?
Yeah, sure.
We see price action go up into the rotation zone and then come back lower. I'm selling that.
Got it. That makes sense.
All right. Now there's other things that go into it. Is there like a significant level in the way of the, what's the longer term chart look like? Like, what does the weekly look like? For example, if I put up a weekly, now the weekly is pretty clear, but basically this tells me that it can get as low as the rotation zone on the weekly, which is about 54.5, right?
Yeah.
54.7. So that would kind of be my target for that trade. Now, I need to stress, I'm not shorting it now, and I have no intention of shorting it until that price action plays out. So I don't disagree with what you said, because if it breaks back out above, what we'll have is a double cross. It'll cross down, then cross back up, and it'll be setting up for long trades for me.
Yeah.
So
Okay,
I don't
that's what I'm
disagree
looking
with
for.
your trade.
I'm neutral, just watching it until that happens.
I'll give you an example of a double cross. Here's one right here. Crossed lower, crossed up, no rotation zone. I'm not doing anything.
Boom.
Now we have a rotation zone, goes into the zone and turns back up. I'm long here.
Wow. It's a good place to be long.
Yeah. Well, I didn't do it.
I know. I mean, that's just what we look at, but I agree completely. Yeah. Do you want to look at any one more thing? Or you want to call it a day?
No, we can call it a day. Hey, Christopher, you can get rid of that chart if you want.
So to you guys, this has been Tradier's The Trader's Edge. It is nothing without the support that you guys give us. Thank you very much. And you know what Bobby and I's mission is. We've been in media a long time. We know that there's a lot of bullshit that happens in media. We are trying to contribute to and create platforms where people can give their honest opinion, not have to worry about sponsors leaning on them. This is one of those things. Thank you guys so much for tuning in.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.